A lot of investors today are wondering why they should be owning bonds at all when they can walk into a bank or credit union and buy GICs with rates of between 3 to 5%. Those GICs are of course guaranteed while bond rates are not. So in this video, I'll go through the situations in which it makes more sense to hold GICs in your portfolio and others in which you might be better off holding bond funds. GICs are a popular investment option for many Canadians due to their low risk and guaranteed returns. They're ideal for those who want to park their money somewhere safe for a short period of time. Usually that's less than 3 years. Another benefit of GICs is that they offer CDIC insurance, which means that your investment is protected up to $100,000 in case the bank or financial institution goes bankrupt. Additionally, GICs are easily accessible. They have a low minimum investment requirement, and you can walk into virtually any banking institution and get one. On the other hand, bond funds can be more liquid. You don't have to lock in for a certain number of years like you do with GICs. And while your rate might not be guaranteed, investing in bond funds helps to spread out your risk. You're essentially buying a basket of bonds issued by different companies and governments. But the main reason to invest in bond funds is to diversify your portfolio and reduce your exposure to stock market volatility. Here, I've included all the calendar years since the mid-1990s in which Canadian stocks declined as a whole. And in almost all those years, bonds moved in the opposite direction. The big exception was 2022, when both stocks and bonds declined, and those declines were triggered by a rise in interest rates. Generally speaking, though, you can see that bonds zig when stocks zag. Now, it is important to keep in mind that both GICs and bond funds have their own sets of risks and drawbacks. GICs have a fixed rate of return, which means you won't benefit from any potential increase in interest rates. Additionally, GICs have limited liquidity, which means that you might face penalties or lose out on interest if you need to access your money before your investment term is up. Bond funds, on the other hand, are subject to interest rate and credit risk. This means the price of bond funds fluctuate from day to day. Now, generally, they are less volatile than stocks, but as you saw in 2022, bond funds can also experience periods of heightened volatility, especially when interest rates change significantly over a very short period of time. So when should you choose one over the other? Well, if you need to use your money in less than 3 years, then you need a safe option. And GICs or other low-risk savings options like money market funds could be right for you. However, if you're looking for diversification from stock market volatility and have an investment horizon of 3 years or more, then bond funds might serve a place in your portfolio. And that is what it comes down to. GICs are useful shorter-term savings vehicles, while bond funds are mid to long-term investment vehicles. If you found that helpful and you're interested in more practical tips on investing, then subscribe to the channel and download a free copy of this book. It's really not rocket science. It's full of lots of advice that you can use to become a better investor. We've included a link in the comments. Until next time, happy investing.